Bank for International Settlement. Now friends, if you look at the founded way back in 1930, sometimes such kind of question is also asked when it was formed. It was founded way back in 1930 as a consequence of World War I. The BIS is not any financial body, it's not just any financial body, rather it is the central bank for central bank. Yes, you heard that right. Central bank for central bank. Now let's look at the founding history. As you can see, it is owned by the central bank from various countries including India, and its primary mission is to act as a bank for member central bank, helping them work together smoothly. If you look at the headquarters, so basically headquarters is located in the beautiful city of Basel, Switzerland. BIS also has global presence through its representative office in Hong Kong and Mexico City. Yes, it has some representative office in Hong Kong and Mexico City also. Now meet the real decision maker. So who is the real decision maker? That is the board of BIS. They don't just set policy, rather they steer the strategic direction of the bank. They oversee the management. They ensure everything run as per the BIS statutes, and they meet at least 6 times a year to keep things in check. They meet at least 6 times a year, remember this. Now if you talk about the advisory committee, so friends, it support the board. Basically supporting the board are 5 powerful advisory committee. Remember, question may be asked, how many advisory committee are there? 5 advisory committee. From, you can see, administrative committee, audit committee, bank and risk management committee, nomination committee, right? So basically they all working tirelessly to ensure solid governance, sound governance. So the next time you think about global finance, remember the BIS might not just be the silent backbone, keeping central bank in sync around the world. So this is the complete summarization of this particular slide. As you can see, BIS, founding history, headquarter, board of BIS and advisory committee. So this thing we have covered now. Now friends, let's switch our focus to the next topic that we have. This is nothing but 1996 amendment. Let's take a step back into the 1996, a game-changing year for global banking regulation. This was the year the Basel Accord took a bold leap to maintain something far more dynamic, that is called the market risk. Let's understand. First thing first, 1996 amendment to the Basel Accord. This amendment added a whole new dimension to the risk regulation, not just for bank but also for non-banking financial firm exposed to market volatility. So first of all, if you look at the silent feature of the amendment, let me take you to the silent feature of amendment. As you can see, so friends, at its core, the amendment introduced VAR. VAR, value at risk, right, or VAR model for calculating market risk. It promoted a building block approach. What it promoted? It promoted a building block approach and pushed for transparency through mark to market valuation, that is called MTM. So proprietary model, right? So in-house model for risk, capital charge higher of the previous day VAR or 3 into 60 day average VAR. Alternative approach means building block method, right, and separate M2M position. So this was introduced by the 1996 amendment. Then comes focus on VAR computation. Here you can see it focus on VAR computation. So VAR was not just a buzzword, right? It has a structure. It is calculated daily with 99% confidence, a time horizon of 10 days and a historical data period of 1 year. Accuracy was not optional, it was a must. So that is called VAR computation. VAR has a structure calculated daily with 99% confidence, right? You can see, and a time horizon of 10 days and a historical period of 1 year. Accuracy was not optional, it was a must. Then we have capital charge and proprietary model. What is capital charge? So banks were not allowed to use their in-house model, that is proprietary model, to measure. This is what I am telling you, that banks were not allowed to use their own in-house model, that is called proprietary model, to measure the risk. Rather, with freedom came responsibility. The capital charge, how to calculate the capital charge? Either the higher of the previous day actual VAR or 3 times the 60 day average, higher of these two, right? Previous day VAR, you either take the previous day VAR or 3 times the 60 day average VAR. Whatever is higher, that will be the capital charge, right? This was introduced in the amendment, 1996 amendment. VAR competition, I already told you, 99% confidence level, right? So and time horizon of 10 days and historical data period of 1 year. Now friends, let's talk about the tier 3 capital. Let me introduce you to here something called tier 3 capital. See, basically to support this, bank could issue short-term subordinate debt, and this short-term subordinate debt is called tier 3 capital, is specifically to cushion the market risk, right? But it comes with lock-in clause to ensure stability. Then let's move to the back testing. What is back testing? But how do we know these model actually work? Enter back testing. It means comparing the model prediction with the real outcome. If things don't match up, bank get a plus factor penalty. Here you see the plus factor penalty is added to their capital charge. Now let's look at the trading book segregation. Friends, also introduced was the trading book segregation, which meant that position has to be separated and marked to market. This keeps the trading side of the bank transparent and accountable. So this is entire thing. Just now I'm just zooming out. So basically with this amendment, Basel did not just rewrite the rule, rather it redefined how risk is understood and how it is managed across the financial world. A bold move that laid the foundation for modern risk framework. Remember, market risk was introduced in 1996. That is what is the main thing. Tier 3 capital parts, proprietary model, right? So bank allowed to use, here you can see, and then proprietary model, in-house model for what is proprietary model? That is called the in-house model for higher risk. That was introduced. The concept was introduced. Then back testing, right? VAR model was allowed for calculating the capital charge. How to calculate the VAR? Just now I told you. Now friends, let's look at the next point. So these were the amendments which were made in 1996. Now Basel II Accord, very important thing. So friends, Basel I was a starting point, but just like any fine first draft, it came with own set of limitation, and that is exactly where Basel II steps in, a refined and risk sensitive framework. So let's break down the gap first. Basel I uses a one size fit all approach. Whether a bank held AAA rated security or risk B rated one, the risk weight was same, that is 20%. That is not risk sensitive and definitely not realistic. Right, so that is what was the key issue with Basel I, that it was not risk sensitive. So it uses Basel I uses a one size fit all approach. Whether a bank held AAA rated security or risky B rated one, whether they had AAA rated security or risky B rated one, the risk weight was same, which is 20%, uniform risk weight. That is not risk sensitive and definitely not realistic. So now let's look at the financial decision making. So basically, this uniform treatment distorted decision making. Banks were pushed toward high risk asset because there was no real distinction in how risk was assessed. Risk return trade off ignored. That was the point. Right, that is called focus on financial decision making. Now friends, credit risk mitigant appear on the screen. So basically what happened, credit risk mitigant. So on the top of that, Basel I completely excluded the credit risk mitigant like credit derivative, securitization, collateral, guarantee, tools that are essential in modern banking. So what we are discussing right now is the limitation of the Basel I. First thing I told you that Basel I use a one size fit all approach. Whether a bank held AAA rated security or risky B rated one, the risk weight was same 20%. That is not risk sensitive, definitely not realistic, right? This uniform treatment distorted the decision making. Banks were pushed toward high risk asset because there was no real distinction in how risk were asset. Then we have it also ignored the credit risk mitigant, right? And let's not forget the biggest blind spot, that was the operational risk, right? With the rise of cyber threat, fraud and tech driven disruption, Basel I has no answer. So these were the limitation of Basel I. Now let's look at the Basel II. Let's see how Basel II. So basically how Basel II rectified it, let's look at it. So Basel II was not just an update, it was a complete revision that addressed the shortcoming of Basel I, right, and prepared the global financial system for more accurate, flexible and modern approach. Right, so basically what are the achievements of Basel I? Let's look also. Capital requirement was clear and it formed the foundation for Basel II and Basel III. Now friends, let's look at the Basel III, right, very important. So basically this pillar ensures, so basically let's now dive into the heart of the Basel III, that is called pillar 1, that is called minimum capital requirement. So this pillar ensured that there are three pillars, minimum capital requirement, supervisory review, market discipline. These are the three pillars. So first pillar we are talking about capital requirement. So this pillar ensured that banks maintain minimum capital to safeguard themselves and the entire economy from unexpected loss. But how is that capital calculated? So basically if you look at the capital for credit risk, so basically we have first we have capital for credit risk, the risk that the borrower might default. So Basel III offered three ways to measure it: a standardized approach, internal rating based foundation approach and internal rating based advanced approach. The more advanced the method, the more control the bank has over calculating risk, but also the more responsibility. Next up we have something called operational risk. So you must know what are the approach, very important. So if you want to calculate the capital for operational risk, which means losses from failed process, people, system, external event, so this can be calculated using basic indicator approach, which is a simple formula, a standardized approach based on business line, and advanced measurement approach, which is tailored to the bank's own data. And if you look at the capital calculation for the market risk, means the risk of losses due to change in the market price, it is measured during a standardized approach, maturity method, a standardized approach, duration method, and internal model method, allowing sophisticated bank to use their own risk model. So bring it all together. So basically whether it is credit risk, market risk or operational risk, Basel III pillar 1 ensure that every angle is covered and every risk is backed by the capital. So friends, if you are looking for a study material where you don't have to spend large number of hours to understand the concept, we will just cover what is important, then you can go for our crash course. Our crash course is designed in such a way that we cover only those things from where questions are repeatedly asked. We ignore those things from where questions are not being asked. Just for knowledge purpose, no, we are not covering that. Right, we are covering only thing that matters from examination point of view. If you want to get detail regarding it, please see the description section. In description section you will get a number. You can WhatsApp me, or you can just install the app. Right, you can also get the course link. Now friends, let's look at the capital requirement for bank. In this particular slide, you will understand, right? So let's decode the number behind the bank financial strength, that is called capital requirement under Basel 3. So what does it mean? See, first of all, we have CET1. Let me zoom a little bit so that it becomes clearly visible to you. First of all, we have CET1. As you can see, CET1 capital, common equity tier 1 capital. It is the most loss absorbing form of capital, made up of mostly of common share and retained earning. Right, common share and retained earning. Bank must maintain at least 5.5% of this risk weight asset, of their risk weight asset in CET1 to avoid credit, market and operational risk. So you can see the limit is, this is at least minimum 5.5% they have bank have to maintain. Then we have CCB, capital conservation buffer. So added to that, the capital conservation buffer of 2.5% also held in CET1 form. Remember, this CCB is also held in the form of CET1, common equity tier 1. This buffer acts like a financial cushion, ensuring that bank can absorb loss even in tough time. So together with CET1, if you add 5.5 plus 2.5, it become 8%. So the total requirement become how much? 8%. You just add both of them. 5.5 plus 2.5. The CCB will be 8%. Then we have AT1 capital, additional tier 1 capital. So this is the supplement to CET1 that add more strength, more flexibility, and the maximum. See, this is the maximum limit is 1.5%. Right. So this is basic thing you must remember. Right, so AT1 is how much? You can see 1.5%. Then comes tier 1 capital. Tier 1 tier 1 includes CET1 and AT1. You combine CET1 and AT1. So CET1 is 5.5% and AT1 is 1.5%. Total you get 7.5%. So total you get 7%. Right. So bank must hold at least, this is the minimum amount, minimum 7% of their risk weight asset in this form. You can see tier 1 capital is 7%. Fine. Then we have the total capital finally. So total capital is what? So total capital is which includes tier 1 plus tier 2. So tier 1 maximum can be 2% of RWA, right, maximum. So overall it is 9%. And if we add CCB, it become 9 plus 2.5, that is 11.5%. So this is the complete breakdown of the capital that bank has to maintain, right, minimum and maximum amount. Now friends, let's look at this particular table, super important table, right. One case study based on this is most frequently asked. So basically bank are required to hold 5.5% of their risk weight asset in the form of CET1, the purest and the strongest form of capital. Add CCB, which is 2.5%, which is also maintained in CET1 form. This act like a protective layer to absorb stress in challenging economic time. So together with CET1 it become 8.8%. Now moves to that AT1 capital. AT1 capital maximum should be 1.5%, and if we combine CET1 and AT1, which become our tier 1 ratio, which is 5.5 plus 1.5, which is 7%, minimum 7%, because CET1 minimum is 5.5%. So together we have tier 2 capital of tier 2 capital. Tier 2 capital is how much? A supplementary layer with a cap of 2%, maximum is 2%. So if you add tier 1 and tier 2, you will get how much? Total tier 1 is 9%, right? And if you include CCB, capital conservation buffer, the total capital requirement become 11.5% of RWA. In short, bank don't just operate with money, they operate with a layer of safety, a structure to handle uncertainty, absorb shock and protect depositor. Now friends, let's come forward to this particular slide, right? In this particular slide, we are going to study eligible credit rating agency for capital adequacy. So friends, have you ever wondered how banks decide the riskiness of their investment or exposure? How do they decide how much risky their investment or proposal is? Friends, if we talk about the India, right? So India, several approved credit rating agency help assess the credit worthiness of borrower and security. So what are these? CAIIB rating, CRISIL, ICRA, Indian rating, acute rating and Infometrics. So question is asked like that which of the following is not a domestic rating. So you must know the name at least, right? Full form will not be asked, everything has full form also, we are not going into detail, right? All of these are recognized domestic agency and the rating plays a crucial role in determining the risk weight for capital adequacy calculation. Then we have on the other side, that is not all, when exposed to cross border, right? When exposure cross border, international standard steps in. Globally, there are 3 key agencies are used: Fitch rating, So if you look at the international agency, that is global standard, so when exposure cross border, international standard steps in. Globally, three key agencies are used: Fitch Rating, Moody's, and S&P. So these agencies provide rating for international exposure, and in certain cases banks are guided to refer to other RBI approved guidelines. Right, now the twist is that risk weight are applied only if an exposure is rated by eligible and recognized agency. So if it is rated by eligible and recognized agency, then only risk weight are applied, right? If not rated, then a standard risk weight apply as per the regulatory norms. So that is what I want to tell you. If it is rated by the eligible agency, then use agency risk rating for risk weight, and if it is not, then a standard risk weight apply as per the regulatory norm. So the next time you hear about a rating, remember it is more than a score. It is a gatekeeper that decide how much capital a bank must hold. In banking, rating don't just influence decision, they shape the risk itself. Right, risk rating don't just influence decision, they save the risk. That is, you can see the importance of this risk. Right, now friends, let's switch our focus to the next topic, that is the capital charge for market risk in banking. There is a topic called disallowance, and one case study based on this asked. I have explained the detailed topic in one separate video. If you want me to provide link of the video, you can just write yes in the comment section. I will provide the link. There's a case study asked regarding disallowance based on this capital charge for market risk. I will provide you the link. So let's dive into a powerful part of the banking risk, that is called market risk capital charge. First of all, what is the scope? So market risk capital apply mainly to the exposure in trading book. Let us look at. So it applied to the exposure in trading book, including interest rate equipment, equities, and foreign exchange risk. So it includes, if we talk about the scope, as you can see, it apply mainly to the exposure in the trading book. What are the exposure in the trading book? Including interest rate equipment, equities, foreign exchange risk. So foreign exchange risk includes gold and other precious metal. Right, now whether it is trading book, banking book, the risk has to be covered. Whether it is trading book or banking book, the risk has to be covered. Right, so that is the scope of it. Now if you look at the measurement of capital charge, as you can see it here, so how do bank measure this charge? For interest rate, capital is calculated on instrument mark to market as per the RBI norm. Further, it has two components: a specific risk and general risk. So again, I'm talking about how do bank measure. So whether it is trading book, whether it is banking book, the risk has to be covered. I think you know about trading and banking book, right? So how do bank measure this capital charge? So we are talking about market risk capital charge. For interest rate risk, capital is calculated on instrument mark to market as per RBI norm. Now it has two components. The first is called a specific risk, means the risk related to the issuer or the security itself. Some risks are there which are related to the issuer or some securities. It captures sudden price change or positions, which means long or short, in the instrument like derivative and government security, which is risk related to the issuer or the security. Like some risks are there in the derivative, which is the kind of security. Government security, some risks are there, and issuer sometimes risks are there. Right, then we have the general risk. It relates to the broader interest rate movement and how they impact all security. So the long or short position are adjusted accordingly. So we are talking about measuring the interest rate risk. Capital is calculated on instrument mark to market. So those instruments which are marked to market as per the RBI norm, only on those instruments interest rate risk capital is calculated. Two components are there: a specific risk and market risk. A specific risk refers to the risk related to the issuer or security, and general risk refer to the broader interest rate movement. Now friends, let's look at what the trading book include. So here you can see trading book definition. As you can see, what are the included under trading book? First thing is HFT, held for trading; AFS, available for sale security. Second thing is, in our case studies which we have conducted daily session, I have provided you detailed discussion on this, which kind of question is asked from HFT, AFS. If you want those kind of videos, it is available in our course. So friends, trading book includes HFT and AFS, often FX position and gold position, trading derivative, even hedging derivative is also included in trading book. Now let's look at the capital compliance. So what is the meaning of capital compliance? As you can see, let me show you capital compliance. Here it is, compliance requirement. So basically, capital charge compliance is not a one-time thing. Bank must maintain continuous capital for market risk. The bank must perform daily EOD, end of day compliance. Bank must monitor intraday market risk. There are exception also exist, like security that are unpaid and matured, they are treated as credit risk, not market risk. Remember it, very very important. Some security which are unpaid and matured, they are treated like credit risk, they are not treated like market risk. And one more thing, if a security remain unpaid beyond 90 days, it is treated as NPA with credit risk weight. This is very important thing. So those kind of security, question may be asked that suppose there is an unpaid security which is matured security, how will you treat it? What kind of risk is it exposed to? So the answer will be it is exposed to credit risk, not market risk. This is very important thing. Just by seeing the word security, you don't decide that it is market risk. You must see whether unpaid maturity is there, then it is credit risk. Also 90 days NPA, if a security remain unpaid beyond 90 days, it is treated as NPA. So these kind of questions are asked, right? Minute point. They're asking from each and every line of the book to check your conceptual understanding. Now friends, if we look at the Basel prescribed method, so let me tell you that what the method Basel prescribed. In India, we follow something called the standardized method. Here you can see we are everything we are talking about market risk, right? We are talking about the market risk. In India, which method we use? We use standardized approach, especially the duration method, which use modified duration to capture the price sensitivity, right? In India, we use a standardized method, especially the duration method, which capture the price sensitivity. And what about the internal model method? So well, it is not fully developed here. So in short, every price move, every rate swing, every foreign exchange fluctuation, they can shake a bank capital, and that is why market risk is not just vast, rather it is capitalized. Right, I hope that makes sense to you. So you can see approach maturity method, duration method, and modified duration method. So duration method is used in India, right? And already we have seen interest rate, capital charge component, specific risk, and general risk. So this entire thing summarizes this entire capital charge calculation for market risk. We have seen the scope and coverage. We have seen the trading book definition, right? Compliance requirement, Basel method, measurement of capital charge. You can see now, if you want to revise the entire BFM content in just one day, how this entire PDF will be helpful, isn't it? I have just compiled all the PDF in single PDF. You just need to go through all these flowcharts and diagram. Everything will be in your mind, and you can answer any question easily based on them. Now friends, let's look forward and let's see general market risk capital requirement. Very important part. Just now I told you there are two kind of risk, specific risk and general risk. So what are the components of general market risk? Let's go through it. Friends, let's unravel the concept of capital charge for market risk, a critical aspect of modern banking regulation. Capital charge is applicable to the bank's trading activity, right? What it includes? It includes, here, let me take you. It includes interest rate equipment. Yes. So we are talking about general market capital charge. So it includes interest rate equipment, equities. Here you can see the three things, right? Interest rate equipment. So friends, we are diving deeper into general market risk requirement for the trading book, where precision and strategy go hand in hand. First of all, what is the meaning of this net trading position? Whenever I say this word net trading position, what does it mean? See, it is a net long or net short position that help in derivative or government security, right? So remember one more thing important, that is called net position. Net long or net short position, that is held in the derivative or government security. And one more thing is that only short position are permitted in this instrument, but with clear disallowance in place. Only short position is permitted, right? Short position is permitted in derivative and government security with clear disallowance. What is the meaning of disallowance? See, to avoid excessive benefit from artificial offsetting, we apply the disallowance, so that we do not get excessive benefit from artificial offsetting. And there is vertical disallowance which apply to position within the small time band, which is a small percentage, typically around 5%, and horizontal disallowance which apply across different time band, and here is the percentage is larger since risk vary more over the time. So vertical disallowance is also there, which apply to position within the same time band. Remember, within same time band, vertical disallowance apply, typically around 5%, and horizontal disallowance apply across different time bands, and the percentage is larger since risk vary more over the time, right? That's why percentage is sometimes you will see 100%. So you must remember the horizontal disallowance percentage. You must remember it. There is a table given in your book. I should also include that table here. I will include it in this PDF. So you must know what is the horizontal disallowance between June 1, June 2, June 1, June 3, June 2, June 3. This must be clear. Now when it comes to option, right, the capital charge is calculated on net basis, right? So it means if applicable. Now friends, standardized duration method is the heart of calculating general market capital. So let's look at the standardized duration method. We are talking about general market risk, trading book. So friends, how it works? See what we do. That step number 1, we use modified duration to measure the price sensitivity to the interest rate change. Means how much price is sensitive to the interest rate change. How do we do it? We use modified duration. This is called yield shock, right? Is range between 0.6 to 1%. And in step number 2, what we do? We slot each instrument into 15 different maturity band, right? We slot each instrument into 15 different maturity band. So what does it mean? What is the meaning of this 15 different maturity band? Let me explain. So then we apply 5% vertical disallowance within the same band and higher horizontal disallowance across band, right? First of all, we use the modified duration to measure price sensitivity. Then we apply allowances. Just now we have seen what is the meaning of allowances. Now friends, what about the currencies? Yes, for each currency you create separate maturity ladder. No offsetting is allowed between currency, but there is an exception. What is the exception? If currency turnover is insignificant, that is less than 5% of the total turnover, you don't need a separate ladder, right? So there is an exception which we can see, insignificant currency turnover. Suppose currency turnover is insignificant. Insignificant means what? Less than 5% of the total turnover. You don't need a separate ladder. Rather, you simply slot net long or net short position in each time band, sum up the gross exposure which is long and short, and apply the appropriate yield shock which is given in table 13.2 of your book. And remember, no offsetting allowed in these minor risks. So to summarize, the capital requirement for general market risk under the standardized approach ensure that banks are well capitalized against shifting interest rate, especially across maturity band and currency. Then friends, we have the capital adequacy, very important part we are discussing now. When we talk about capital adequacy, we often hear about pillar 1 and pillar 2, but what exactly do they mean and why both matter? See, pillar 1 is about the foundation. It covers the minimum regulatory capital requirement, which we have already seen, right? Which bank must hold against the three major type of risk: credit risk, market risk, operational risk, right? But these are quantified using a standardized formula. It is structured, measurable and regulatory driven. But here is the catch. What is the catch? That pillar 1 does not tell the full story. There are critical risks that pillar 1 does not fully capture, and that is where pillar 2 steps in. This is the pillar 2. So under pillar 2, banks are expected to internally assess and hold additional capital for a range of residual and emerging risks. So these are the risks which are not fully captured under pillar 1. So questions are like this: which are the risks which are not fully captured under pillar 1? First is interest rate risk in the banking book. Unlike trading book risk, this affect long-term loan and deposits. Credit concentration risk, when too much exposure rests with a few clients, sectors or region, it is not captured by pillar 1. Liquidity risk, the danger of running out of cash when it is most needed. Settlement risk, you know what is settlement risk? At very macro level it happens, right? Strategic risk, you know, risk from poor business decision or changes in the market landscape. A strategic risk, that is what risk from poor business decision. Reputational risk, where loss of trust can damage the bank far beyond number, and even the underestimation of the credit risk itself. So these are not always captured in formula, but they are very real and potentially very costly. That is why, you know, pillar 2, the focus is on bank on internal capital adequacy assessment, that is called ICAAP, right? ICAAP process. It is guided by risk culture, stress testing and forward looking analysis. So in a sense, pillar 1, so we can summarize it like, you know, pillar 1 ensure minimum safety and pillar 2 ensure long-term strength. Together they create a balanced framework for protecting both the bank and its customer from the unexpected. And these two tables are super important. Case studies are asked every year. You must mug up the formula. Let me tell you how to do it. So friends, let's decode a very important regulatory tool in banking, that is called, you know, CCB. Capital conservation buffer. See, the idea is simple and powerful. A cushion that safeguards bank during tough time. A stronger capital, more flexibility, safer banking system. So how does it work? Banks are required to maintain a certain CET1 ratio, that is their core capital. Now, if a bank's CET1 ratio start dipping close to the regulatory minimum, say 5.5 to 8%, if the bank's CET1 ratio start dipping close to the minimum, right, then restriction kicks in. Right, not a penalty but a conservative rule. This is where capital conservation ratio comes into picture. You see this written, minimum capital conservation ratio, right? So that is when kicks in. So let's break it down. If the bank CET1 is between 5.5 to 6.125, it must retain 100% of its earning, no dividend payout. This you must remember. If it is 6.125 to 6.75, the bank must conserve 80% of its profit. If it is between 6.75 and 7.375, then 60% need to be retained. If it is between 7.375 to 8%, then 40% of earning must be conserved. And once CET1 is above 8%, the bank is free to distribute 100% of its earning, no restriction. So I hope this is clear now. Talking about trading book is just covered in one single slide. Let's go through. So what is trading book? You can think of it as a special portfolio that hold asset a bank intend to trade frequently. Right, so those assets which bank intend to trade frequently, these are included in trading book, and all for short-term profit. Right, everything for short-term profit that bank intend to trade frequently for short-term profit. So these are included in the trading book. So what are the core component of the trading book? As you can see, debt security, right, equities, foreign exchange, derivative and commodities. So these are the go-to instrument when bank aim to make profit from the market movement. If you look at the trading intent on the right hand side, you can see what is the trading intent. So the intent behind the trading book is to capture short-term gain. The main intent behind the trading book is to capture what? Capture the short-term profit. It's all about profiting from the price difference between what is expected and what actually happened. It also includes some hedging activity, right? So that is called trading intent. it's all about profiting from price difference. What is expected, what actually happened. It also includes some hedging activity. That is called the trading intent. What are the risk involved? Let's see the risk involved here. Yes, very very important. Trading book, what kind of risk involved? The first risk is called market risk, which fluctuation in the rate or forex can affect the value. Then the second is called liquidity risk. There might be delay in buying, there might be delay in selling. Then the third risk is called asset liquidity risk, because these kinds of core components are there. So for every instrument, risk are also involved. Asset liquidity risk means some asset are simply hard to sell, you can't sell some kind of asset. And market liquidity risk, what if there is no buyer in the market? That is called market liquidity risk. Then we have credit or counterparty risk, which means default or downgrade can shake the things up. So remember, question can be asked, which of the following risk can be is a part of trading book? So remember, market risk is there, liquidity risk is there, credit risk is there, operational risk is not there, asset liquidity risk is there, market liquidity risk is there. So I hope it is clear now. Additional consideration, as you can see, so don't forget, market risk also include unexpected loss due to high volatility, which directly hit earning and capital. So the trading book is all about strategic short term play, but bank need to stay sharp, because risk and reward goes in hand. Now friends, let's come to the next slide. That is, we have understanding trading liquidity and the associated risk. Very very important. So let's dive into one of the crucial aspect of financial market, that is called trading liquidity, and why it is a big deal when it comes to the trading risk. First of all, what is the meaning of this trading liquidity? See, at its core, trading liquidity means easy to trade at fair price with no big price impact, right? So it means trading liquidity means what? Means that easy to trade, you can trade easily, fair price it have, right? So you can see price, fair price is that with no big price impact, right, without drawing too much attention, and with safe quality counterparty, right? That is called trading liquidity. In short, it is a smooth experience that every trader hope for. But what happens when liquidity dries up? That is the consequence of liquidity. So you can see now, easy trade plus fair price plus no price impact plus no attention plus counterparty quality safe, right? So with no big price impact, without drawing too much attention. But what happens when liquidity dries up? You can see, first of all, imagine this: price is falling suddenly, you can't sell at fair price, you are forced to sell at loss, right? And worst of all, no one is buying. So that is that is called liquidation risk in action. It is a nightmare of every trading desk. This liquidation risk is a kind of nightmare. So these are the consequences of liquidation risk. If you look at the type of liquidation risk, we have two types: asset liquidity, which means asset itself is very hard to sell even though the market is functioning, and the market liquidity, which means the entire market dries up, no activity, no trading, totally freeze. So these are the two kinds of liquidity risk we have. Asset liquidity means asset is hard to sell, right? And market liquidity, which means the entire market dries up, no activity, no trade. Then let's see the risk involved. So liquidation risk is a sum of two kind of risk: asset risk plus market liquidity risk, right? So it is a perfect storm. And remember, the lower the liquidity, the higher the price volatility. So I try to understand, very very important. Liquidation risk is the kind, it includes two things: asset risk plus market liquidity risk. Suppose liquidity is high, suppose high liquidity, it means price will stay stable. If there is a low liquidity, then price will swing wildly. That is called adverse movement in the price. So basically two things are added to get liquidation risk: asset risk plus market liquidity risk. And perfect storm, and lower the liquidity, the higher the price volatility, right? If higher liquidity is there, it means a stable price stays stable, and low liquidity means price will swing widely. So liquidity and price volatility, they are inversely proportional, as you can see it here, right? Now friends, let's look at market risk versus market liquidity risk. What is the difference? Here you can see very very important. Market risk means what? Let's clarify it. Market risk means what? Price change due to rate, forex and indices. But liquidity risk is what? You can't sell what you want at the price you expect. That is called liquidity risk. Means suppose you expected some price, you are not able to sell that at that price, and also you're not able to sell what you want to sell. That is called liquidity risk. Often they interact, especially in the volatile market. Market risk and liquidity risk, they interact, right? It is like trying to sell a car during a storm. Suppose a storm has hit your city and you are trying to sell a car. Bad timing leads to bad price, right? So that is called interaction between market risk versus market liquidity risk. Then we have, we are talking about market liquidity risk here. We are not able to sell something, right? Then we have emerging market, a special case. Here you can see. So friends, emerging market are particularly vulnerable. They often face high liquidity risk, meaning the price you get does not reflect the asset fair value. That gap can cost trader heavily. So to wrap it up, trading liquidity, we are talking about trading liquidity. Trading liquidity is not just about being able to trade, right? It's about trading smoothly, fairly, safely, and when liquidity vanishes, the risk will skyrocket. That is what the main gist of this particular topic. Friends, if you want such kind of videos, right, where each and every concept is explained using this kind of flowchart mind map, so that you can easily revise, you can devote 80% of the time to understanding, right, to basically numerical solving, and just 20% to the understanding. You can enroll in our crash course. The detail of crash course is provided in the description section. You can WhatsApp me on the number 8292857381. The same number is provided in the description section of the video for more detail regarding the crash course. Now friends, let's switch our focus to the market risk management. Who does what? So let's decode an important concept that is called market risk management and responsibility with a super clear breakdown of the key player involved. So the first player is the board of director. Basically, they are at the top of the pyramid. Their job is to set the tone for the risk. They define policies, they set the risk limit, they review, they audit regularly, they control risk related to the liquidity, interest rate, foreign exchange and equity. So these are called the board of director. So they act like a guiding hand for the risk governance. The second on the list we have, is called risk management committee. Here you can see RMC. So they think of them like, enforcer of the rule. So whatever rule board of director has created, this is enforced using risk management committee. So they ensure that guidelines are followed. They ensure policy adherence. They monitor the prudential limit. They validate the risk model, and they handle the risk staffing. They make sure that risk is not just written down but actually managed. Then we have the ALCO. ALCO, here you can see ALCO, Asset Liability Committee. The question was asked regarding the ALCO, functions of ALCO. They are the real strategists, right? They connect business goal with the risk control, right? They connect the business goal with the risk control. They protect net interest margin, right? They manage asset liability management and interest rate views. They control liquidity and the funding policy. They oversee transfer pricing and balance sheet. They set the operational limit. These are the role of ALCO. Right, they juggle risk and return daily. Then we have ALM. Here you can see the ALM, Asset Liability Support Group. So they are the analysts behind the scene. They track the risk profile, they report to ALCO, they run simulation, they suggest action versus scenario analysis. You can think of them as team running what if scenario to prepare for anything. Then we have the middle office. So the gatekeeper of the control and transparency. They are called the middle office. So they oversee the treasury risk. They independently monitor and report. They report to ALCO. They validate pricing, they separate from front office to avoid conflict. So they bring balance between trading and oversight. So again, I'm repeating, basically market risk is not managed by one person. It is a collaborative structure involving a strategy, monitoring, policy. So board of director define the policy, risk management committee, they enforce them, right? They bring into practice. ALCO, you can call ALCO like real strategist. They connect business goal with risk control. ALM support group, here you can see ALM support group, they are the analysts behind the scene. They report to ALCO, run simulation, and middle, they are gatekeeper of control and transparency. They oversee the treasury risk, report to ALCO. So everybody has to report to ALCO, whether it is ALM support group or it is middle office. They have to report to the asset liability committee, right? So friends, each unit has a defined role, and together they protect the bank from unexpected market shock. Now let's come back to this particular slide. Every aspect from where question have been appeared in the previous 2 to 3 or 4 examination have been covered in this particular slide. Now there is a very important thing which is called BPV. So ever wondered how sensitive bonds are to the interest rate change? Have you ever thought about it? Today we are talking about one of the most important tool in the market risk measurement, that is called bond price value or BPV. So what is BPV? Here you can understand. See, BPV tells us how much the price of a bond change when the interest rate change by just 1 basis point. Try to understand. Interest rate is changing by 1 basis point, that is 0.01%. How much will the bond price will change? So basically, 1 basic price change in the yield is equal to bond price change. Two things are there. On one side we have the yield, that is the interest rate. On the other side we have the price of the bond. So 1 BP change in the yield is equal to bond price change. So higher BPV, it means higher interest rate risk. So BPV, is a direct tool to use to assess the market risk. Simple but powerful. Now how to calculate? Let's understand with a quick calculation. So we are given a 5-year bond, right? 6% coupon, semi-annual return. Yield goes from 8% to 7.95%. Price go from, obviously yield decreases, so price increases. Price grow from 92 to 92.1.0. So what is happening here? That price increase 0.10 for 5 BPS. So 0.02 per BPS. So this give us BPV of 2000 per 1 crore face. Just multiply by 1 crore on both the side, rupees 2000. right? So now suppose what happened, that our 8, now imagine 8% BP drop in the yield. So the basic formula is that gain or loss is equal to BPV multiplied by yield change, because BPV relate two things it relate. On one side we have the price, on the other side we have the yield change. Now what is happening here, suppose yield 8%, 8 BP drop. So what will happen to the profit? Ultimately it will increase by 16,000 rupees per 1 crore, right? So for rupees 10 lakh holding, the profit you make is 1600. Not bad, right? So that is the effect. So first of all you find the BBB, and using BBB you can analyze what will be the effect on the gain or loss for a certain yield change. Then look at the maturity effect. Longer the bond maturity, higher the BBB. Remember it. Longer the bond maturity, higher the BBB. At the bond near maturity, BBB gradually fall. At maturity, BBB is equal to 0. This is very important thing, right? In your book, it is written, and you can simply see the summary fact. That is why it's called crash course, because we don't cover everything. We cover only those things which are matter from examination point of view in this particular crash course. If you have not seen the earlier videos, I request you to please go through them. So maturity effect means what? Longer the bond maturity, higher the BPV. As bond near maturity, BPV gradually fall. At maturity, BPV is equal to 0. So BPV help us in understanding risk, planning hedge, and making a smart investment call. If you found this breakdown helpful, don't forget to like, share and follow. Now move to the next slide. Understanding bond duration and sensitivity. So using this slide you will understand every aspect of it, and this will really help you in your final revision purpose. So friends, it was developed by Frederick McCullough in 1938, as you can see. This tells us the average time to receive the present value of all the future cash flow of the bond. That means how much average time to receive the present value of all the cash flow. You can think of, cash flow gravity center. It tells us how sensitive a bond price is to the change in interest rate. Right, so duration tells us how sensitive a bond price is to the change in interest rate. Right, in the previous case BPV we have seen yield versus price. Here interest rate versus price. So longer duration, it means more interest rate risk. Let's take an example. Suppose we have a 3-year 100 rupees bond, 8% annual coupon. So yield is how much? 8%. If we calculate the present value of each year payment and multiply it by time, so we get cumulative PV, right? So which is equal to 278.34, and divided by the bond price, this will give us 2.7834. That is around 2 year, 9 month and 12 day. So just you have to remember the formula, summation of PV into T upon summation of PV. That will give you the duration, right? So McCullough duration is 2 year, 9 month, 12 days. It's like saying the bond act like a single payment made after 2.78 year. And yes, higher the duration, higher the sensitivity to the interest rate movement. Right, so it's like saying that this particular case, right, it's just like single payment after 2.78 year. What is the modified duration? So while McCullough duration tells us the timing, modified duration tells us the price change for 1% movement in the yield. McCullough duration, what it is? It tells you time that this entire bond cash flow we can simulate it like one single cash flow which I will receive after 2.78 year, the same amount, right? Now what is modified duration? It tells us how much the price will change, bond price will change for 1% movement in the yield. So the formula is McCullough duration divided by 1 plus yield. So with McCullough duration, suppose 2.7834, yield is 8%. We can find the modified duration by dividing 2.7834 by 1 plus 0.08, which is equal to 2.57. So suppose interest rate fall by 1%. So the bond price rise by rupees 2.57 per rupees 100. Then we have the price sensitivity. So if you want to estimate the price change without detailed calculation, you can, here is a shortcut. Approximate percentage change in price is equal to negative of modified duration multiplied by yield change. So suppose yield drop by 1%. So price will increase. That's why negative sign is put there. So what is the percentage change in price? Multiply minus 2.57 with minus 1%. Because yield change by 1%. This will give you the new price change, which is 2.57%, and new price is 102.57. So to wrap it up, we have discussed the 3 duration: McCullough duration, average timing of cash flow; modified duration, price sensitivity to interest rate; and price sensitivity, quick price change formula. Now friends, let's look at the VAR, value at risk. Very important aspect from where question are asked. Try to understand every aspect of it. So friends, VAR is like risk thermometer. It tells us the maximum expected loss, right? So here you can see the concept. It tells us that how much maximum you can expect to loss under normal market condition over a fixed time frame and with certain level of confidence. 3 things are there. First thing, maximum expected loss. Second thing, normal market condition. Third thing, fixed time frame. Fourth thing, certain confidence level, right? Now key points is that if you are holding over a long time, right, if suppose you are holding for a long time, right, then your VAR will be higher. And if you are holding for and you have a high confidence interest, see, first thing is the timing, right? That means fixed time horizon, you see. So if you are holding for long time, VAR will be higher. If your confidence level is higher, VAR will be higher. It is used to assess both individual security as well as the entire portfolio, right? You can go forward for individuals in individual security as well as the entire portfolio, right? But here is a twist. VAR, is a statistical estimate, right? Not a crystal ball. It don't predict extreme market crash, just regular fluctuation. So let's give you a real world example. Here you can see one day VAR, right? Let's say you are managing a 10 crore portfolio. Your one day VAR at 99% confidence level is rupees 10 lakh. Fine. What does that mean? This means that 99% of the day your loss won't exceed rupees 10 lakh. But on that 1% of the day, around 2 to 3 times a year, the loss might be higher. That is your risk window. So whenever I say that your one day VAR is rupees 10 crore, one day VAR is rupees, suppose you are managing a 10 crore portfolio, or suppose your one day VAR is rupees 10 crore at 99% confidence level, it means 99% of the time your loss won't exceed this 10 lakh or 10 crore. But on one day, 1% of the time, that is 2 to 3 times a year, the loss might be higher. Now if you look at the VAR model, so here you can see VAR model. Let me take you through that. So there are 3 main model. Here you can see. Okay, we will talk about the method in the next slide. Now volatility, right? Let's talk about this volatility. What is the volatility? This is the key ingredient, of VAR. Let's not forget that VAR is all about the volatility, right? So yield volatility. What is the meaning of yield volatility? So it measures the variation in the yield. It is independent of time or duration. Here time is nothing. Time is not taken into consideration, like we did in the McLeod duration. Here time has no role to play. But it measures the yield variation in the yield, and there is something called price volatility. It measures how a bond price can change, but it depends on time duration, but not that much on yield. And the connection between them is price volatility is equal to yield volatility multiplied by BVV into yield upon price. This is a very important formula. This is your formula for understanding how interest rate movement affect the bond price. Because price volatility depends less on yield, it depends more on the time duration. Then we have important notes. Here you can see. What is the important notes? That VAR is powerful but not perfect. It is a statistical estimate. It is powerful but not perfect. It is not for predicting black swan event, right? That is the point. And one more thing I want to tell you, that some factors are there. Price or rate volatility, it asset correlation, longer time is high VAR, high confidence means high VAR, used for instrument and portfolio. But limitation, I told you, a statistical estimate, not for abnormal market. It measures market risk exposure. Now let's move over to the value at risk, some more points, right? Some more points related to the value at risk in the upcoming slide. So what are the methods to calculate the VAR? Very, very important thing. So friends, some important points related to calculation of VAR. The first we have is called correlation method, right? So correlation method is also called variance covariance method. This is a deterministic approach. It is based on fixed mathematical formula. It uses sensitivity analysis. It uses variance covariance metrics, right? It needs data on volatility, correlation between assets. It assumes that returns follow a normal distribution. That is called correlation matrix. Remember the keyword, deterministic approach, sensitivity analysis, variance covariance matrix. It needs data on volatility, correlation between the asset. It is simple but assume perfect market condition, which is not ideal for unexpected event. Then we have the historical simulation. What it is? This method use actual historical market data and price movement. It is no need for variance covariance matrix or normality assumption. The advantage is that real world based, no need to assume correlation, but disadvantage is that it may miss the rare or new market event that have not occurred in the past. Then we have the Monte Carlo simulation. This is very important. This is the most advanced method. It generates thousands of random market scenario based on assumption. It requires models for volatility, correlation, and market behavior. It is computationally heavy but offer higher flexibility and accuracy. If you look at the limitation of VAR, here you can see the limitation. So that VAR does not show the worst case loss, right? It is not tailored to any one specific market event. It is not sufficient on its own. It shall be supported with back testing, calibration, stress testing, and scenario analysis. It is on it is not sufficient. You have to back it up with stress testing, scenario analysis, back testing, calibration. If we see the core input which are required for VAR, the first thing we need a holding period. That means 1 day or 10-day horizon. Confidence level. There is 95% confidence or 99% confidence. Historical data window. So model accuracy versus actual market condition. Why VAR is useful? Let's look at it. So VAR is used by bank, MNCs, fund manager, financial institution because it converts risk into a clear loss estimate. It provides a single summary number. It helps meet regulatory risk disclosure requirement. It covers part of the modern risk management framework. And some more point you must keep in mind regarding the VAR, right? So some more formula I told you that price volatility, I told you here. Let's see the formula. Price volatility is equal to yield volatility into BPV into yield upon price. Now let's look at this particular test. What is back? You might have heard the back testing, stress testing. What it is all about? These are called risk assessment analysis. So friends, imagine you have built a fancy model that predict the risk. Great, but how do you know it actually work? That is where back testing comes into picture. It compares the model predicted risk, which is the VAR, to actually what happened in the real life. It is usually checked monthly or quarterly. So basically it compares predicted VAR versus actual over time, right? So two things can happen. If the actual outcome fall outside the expected confidence level, right? If actual outcome fall outside the expected in confidence level, there is a red flag. It means time to revisit your data, model assumption, parameter, and even the methodology. Right. So back testing is a standard practice under supervisory framework and is closely linked with the internal model approach for calculating the market risk capital. So back testing is reality check for model. Right. Suppose you have built a fancy model that predicts the risk. It compares the model predicted risk to what actually happened in life. And if the actual outcome fall outside the expected confidence level, that is a red flag. That means it is a time to revisit your data. So back testing is a standard practice under supervisory framework and is closely linked with the internal model approach. Right. Then we have the stress testing. While back testing is like checking the weather forecast accuracy, stress testing is like simulating a storm. You are simulating it, right? So you have built a model, risk prediction is there, but how good it actually works, that is called back testing. Model predicted risk to what actually happened in the real life. If the actual outcome the expected confidence level, that is a red flag. Right. And stress testing, what happened, it asks what if something extreme happened, can we survive it? There are two major techniques. The first is called sensitivity testing, and the second is called scenario analysis, which are the two stress testing technique. So in sensitivity testing, what happened, it look at the short term impact of changing one or two risk factor. Right. And scenario analysis, this is the big picture shock. This was the real historical event like 2008 financial crisis you create it, or hypothetical but plausible disaster designed to see how tough the portfolio really is. So to summarize, right, back testing means checking accuracy of risk prediction, and stress testing is prepare you for extreme unpredictable shock. Together they are non-negotiable tool in the modern risk management. So and because you will get to know from where which topic questions are most frequently asked. We have taken only those topics from where questions have appeared in the last 5 paper of the BFM, right? So let's get started with our first topic, that whenever bank lend money, they don't just look at profit, they look at risk, and the biggest one is called credit risk, right? But the credit risk is not just one big monster, it has its own branches. Let's break it down. As you can see, some branches have written here. We will discuss in detail about this branches. So let me zoom out a little bit. So I hope this is clearly visible to you. So credit risk is split into two types, right? As you can see, portfolio risk and transaction risk. This is the two type of risk, portfolio and transaction. So portfolio risk is about the entire group of loan that the bank has given. It is further includes concentration risk, which means what if too much money is lent to one sector like real estate, if that sector crash, it hit hard. The second is called systematic risk. Systematic means these are the risks beyond one control, like inflation, like recession, like global crisis. So they impact everyone. That is called systematic. That is a part of portfolio risk, right? So portfolio, I told you, entire group of loan that the bank has given. Then we have the transaction risk. Transaction on the other hand is about the individual loan. So portfolio means group of loan. Transaction means a single loan. So it includes default risk. Default risk, we know the fear that the borrower just won't pay back, and downgrade risk, which means even if they are paying, what if their credit rating is dropping, credit score is dropping, that is the red flag for the future. So the next time you hear credit risk, remember it's not just one thing, rather it is a whole network of financial danger. As you can see clearly here, these are the different categories of credit risk that we have. Now friends, look at the credit risk structure. So let's decode the structure of credit risk, the biggest challenge that banks face while lending. You can think of credit risk like a wheel with 5 key spokes, right? You can see, we will discuss each and every part. So first of all, let's start with the systematic risk. I told you about systematic risk just now. Let me explain in detail. So this is the risk you simply can't escape. right? You can't escape this risk. It is unescapable, right? Like recession, like some kind of inflation. So inflation, let me zoom a little bit. I think this is not visible to you. Let me zoom a little bit. Now I think this is visible to you. So systematic risk is some types of recession happen, inflation happen, global conflict happen, even with a diversified portfolio, right? So even with this is called diversified portfolio. This is a mitigation technique. So even with a diversified portfolio, a residual risk always remain. Solution: diversify across industries, borrowers, and geography to soften the blow. You can't escape this particular risk, because if there is something that causes the entire world to economy to soak up, then it will automatically affect bank also. That is called systematic risk. Then we have the next kind of risk that we have is called the default risk. I think default risk very much easily, that this one is pretty straightforward, that what if the borrower failed to repay the loan? Even partial recovery might be possible, but it directly affect the bank bottom line, right? So partial recovery is possible, but it affects the bank bottom line. So this is a key concern for non-MTM, non-mark to market asset. There are two kind of asset: mark to market, non-mark to market. So if there is a non-mark to market asset, then it faces the default risk, right? And where the impact is felt immediately, right? Impact is felt immediately. So this is called the default risk. Then the next risk we have is called the credit spread risk. So this is a tricky one. The borrower does not default, but their credit quality worsen. Here, so see what is happening. The credit quality is worsening. It is decreasing, right? This widens the credit spread. So ultimately, what is happening because of this? That credit spread increases, right? Trigger the downgrade. Ultimately, if credit spread increases, it trigger the downgrade, right? And it affect the bank MTM. Right, it affects the bank MTM exposure. What is MTM? Mark to market exposure. So basically it's all about perception. So this credit spread rate is all about perception. It's all about perception, and basically it's not payment. It's all about perception. So credit spread rate, just now I told you that the borrower does not default, but their credit quality worsen. This widen the credit spread, trigger downgrade, affect the bank MTM. It's all about perception, not payment. The next kind of risk that we have is called concentration risk. What is concentration risk? So don't put all your egg in one basket. If a bank lends too much to one industry, geography, or borrower, a crisis can hit all at once. Remember COVID-19? Sectors like tourism were hit hard. That is concentration risk in action. So that is called don't pull all your egg in one basket. If a bank lends too much to one industry, geography, or borrower, a crisis can hit all at once. Then we have portfolio level risk. Here you can see portfolio level risk. What it is? See, this one is umbrella, right? It covers the entire lending portfolio. It includes both systematic and concentration risk. So managing these together helps stay stronger. So credit is not about will they pay. It's all about how many ways things can go wrong, from defaulting to downgrading, from economics up to our exposure. Bank need to stay one step ahead. That is the final solution to mitigate such kind of risk. I told you some mitigation technique also, right? Systematic, default, downgrade, credit spread, concentration, every aspect we have discussed in one slide, and that is the beauty of our crash course. Now one important concept, rating migration. Question is asked most frequently from it. Let's understand. So ever wondered how a borrower credit rating changes over time? So welcome to the world of rating migration, a crucial tool bank used to track the credit quality over time. So first of all, what is the meaning of rating migration? Let me explain. So this 5 and 6 point will clear every aspect regarding the rating migration. So rating migration simply means, as you can see written over here, let me zoom a little bit. So I hope it is clear now. So rating migration is the shift in the borrower credit rating over a period using the same rating model. So as you can see, change in the borrower rating over the time. So change in the borrower credit rating over the time, right, using the same rating model. For example, suppose XYZ Limited, right? So this XYZ Limited moved from, earlier it was B plus and now it moved to B, right, within 1 year. So all these things happened within 1 year. Suppose it was B plus, it moves to B within 1 year, right? So alone it may seem small, but when you see this shift across 100 of borrowers, it tells a powerful story about credit quality trend. Right? Alone it may seem small. So here it was B plus, and now it become B. Alone it may seem small, but when you see shift across 100 of borrowers, it tells a powerful story about the credit trend. Why this is important? So let's explore 5 key angles. That is what we are going to do. So first of all, the significance part. Just let me show you. Yes. So why is this important? Basically, first of all, let's talk about the significance of it. Just wait a minute. Yes. So basically, individual rating moves might be minor, but group level changes, they reveal the real migration pattern, right? Group level changes reveal the real migration pattern, right? Then we have the multi-year data. As you can see on the right hand side, it is written multi-year data. Here you can see on the right hand side. Just let me erase it. Yes. Okay, now it is okay. So multi migration example. So let's say 100 borrower rated A on 31st March 2016. On 31st March 2016, 100 borrower were rated A category, right? And by 2017, some may have upgraded, right? Some may have downgraded, or some may have defaulted. So this help infer the default probability. So from this thing we can infer that what is the default probability, which is nothing but the 2%. Right? Let's say 2% of A related client defaulted in a year. 2%, which means 2 out of 100 for A rated account, right? So this is the inference that we draw from this data, that we calculate the probability of defaulting for each and every category, for each and every part. Then we have credit rating. Then we have benchmarking. Benchmarking, bank benchmark their internal rating migration with external credit rating agency, right? So bank, what they do, they benchmark their internal rating migration with the external credit rating agency. For example, if a bank show 2%, suppose a bank is there and it is showing what? It is showing 2%. It is showing 2% default while the agency show 0.2%. Bank show 2%, agency show 0.2%. It means bank model may be too risk tolerant and need recalibration, right? Then we have the market interpretation. On the left side, you will see the market interpretation. Let me explain what market interpretation is all about. Let me show you. Yeah, here you can see. So basically what happened, bank also aligning their rating with market expectation. Yes. So if the market sees a borrower as risky, internal models will reflect that also. Suppose market see a borrower as very risky, so the internal models will also reflect that thing. That is very, very important. Otherwise there is a mismatch, and that is a regulatory red flag. And then we have rating model acceptability. For a rating model to be accepted by the regulators like RBI, it must be based on real world risk driver. So what are some real relevant risk driver? Like management quality, financial conduct, business industries. So rating migration is not just a technical term, it's the heartbeat of a bank risk monitoring system. Tracking how rating evolve help bank stay ahead of the trouble before a loan turn into loss, right? That is how rating migration help. Now let's look at the comprehensive strategy for effective risk assessment in finance. So friends, when it comes to finance, one thing is for sure, that risk is everywhere. But the smarter question is, how do we assess the risk effectively? So let's unlock the answer of this question, that how do we assess the risk effectively, with the risk assessment framework, which bring together 5 powerful tool and model used globally by the bank. The first is called Ultimate JAIIB score. Let me zoom a little bit. Right, Ultimate JAIIB score. So I have just added a case study based on them in today's crash course, right, which is numerical based. Right, please go through them. Those who have enrolled in our course, I request you please go to that case study. Sometimes directly 5 marks question is asked based on Ultimate JAIIB score. See, you can think of this as early warning system. So Ultimate JAIIB score, it behaves like EWS. What is EWS? Early warning system, right? It predicts whether a company might go bankrupt within the next 12 months. What is the chance that the particular company will go bankrupt within 12 months? How? By using 5 key financial ratios, right? So by using 5 key financial ratios that combine accounting and equity data, and the result is that it is an objective measure, objective number based snapshot of a firm financial health. Then we have JP Morgan credit matrix. After Ultimate JAIIB score, we have JP Morgan credit matrix. So if you want to know how a loan value might change if a borrower credit rating shift, see what is happening. Suppose borrower credit rating is shifting. And if you want to see, because of the shifting in the borrower credit rating, how a loan value change. If you want to see what is the impact on loan value if the credit rating is shifting, welcome to the JP Morgan credit matrix. It tracks the probability of rating migration, helping bank estimate how much value could be gained or lost. So it track the migration rating, probability of rating migration. That is called rating migration probability. It tracked by the JP Morgan credit matrix. It shows loan value fluctuation, right? It also promote transparency. It support RAROC, risk adjusted return on capital. So estimate, it support RAROC estimate and set the gold standard in the credit rating benchmarking. Then we have Credit Suisse Credit Risk Plus. Right. So what is this credit? So credit risk plus, let's understand. So basically, this one is a bit more mathematical, right? Why it is mathematical? Because it uses an actuarial approach. What it use? It use something called actuarial model approach. It estimates expected and unexpected losses using a statistical model. So a statistical model is used to estimate the expected and unexpected loss. It is especially powerful for FIRB, for AIRB bank. It is especially powerful under Basel norm. From CBAR, right? From CBAR to RWA, it calculates it all, helping sophisticated bank assign capital more efficiently and skip a standard risk weight. Then we have some risk scoring system. So we have discussed ultimate credit score, we have discussed JP Morgan credit metric, we have discussed credit Swiss credit risk plus. Then we have risk scoring system. Simple but powerful. Whether it is retail borrower or a corporate loan, risk score help assign a 1 point risk indicator. So in simple word we can say 1 point risk indicator, right? So this system standardize how we value borrower, right? Retail get a risk score, large loan get a credit rating, but both are driven by the same goal, that is informed, consistent decision. And if you look at the importance of risk rating, what makes a risk rating meaningful? It must be structured, it must be comprehensive, and it should be frequently reviewed. From financial and projection to management quality and industry outlook, everything is included. So regular update keep the rating aligned with the real risk on ground. So risk assessment in finance is not just about models and a score. It's about clarity, it's about consistency, it's about control, right? So these 5 key form a solid framework to open the door to a smarter, safer financial decision. Now friends, let's break down one of the most important, most powerful and widely used concept in modern finance, that we call as securitization. Let's see. Let's talk about the securitization in just one slide. Every aspect have been taken care of in this particular slide, and you will immensely, this particular slide will be immensely valuable for you. So friends, what if a bank could turn its loan into a marketable security, sell the risk to an investor and free up capital? Well, that is exactly what securitization does, and today we will explore its full process, right? Its roles and the key components. So what is securitization? As first is the definition. So securitization, is basically at its core, securitization is a process where illiquid assets, see what is happening here, that whatever illiquid asset, let me write down, whatever illiquid asset we have, right, like loan, these are converted into marketable securities. They are converted into marketable securities. They might happen through a special legal entity that is called SPV, special purpose vehicle. So what is the role of SPV? Let's start with the role of SPV first. The SPV is created only for securitization. First point, they are created for securitization. First point. And the originator, like a bank. Who is originator? Originator you can call the bank, right? So the bank transfer the asset to this SPV. What bank do? Whatever asset is there, bank transfer the asset to the SPV, right? And the SPV then issues securities to the investor. What SPV do? SPV issue security to whom? To investor, right? And manage the interest and repayment collection. Obviously investor will pay the money, then only SPV will issue the security. So this help isolate the asset and reduce the credit risk. Then friends, the securitization type. 2 main types of securitization are there. The first is called traditional and second is called synthetic. Let's understand what is traditional, what is synthetic. See, traditional securitization means it is based on actual asset cash flow. You can see it is based on actual asset cash flow, right? Payments are directly linked to how the asset perform, not the original lender. So payment depends on asset performance, not the originator. And tranche role, junior absorb losses, right? And shield senior from default. So 2 tranches are there, senior tranches and mezzanine tranches. Senior means low risk tranches, mezzanine means high risk tranches. And payment depend on the asset performance. So this is about traditional securitization. If you look at the synthetic securitization, so here credit risk is transferred via derivative. In the case of synthetic securitization, derivative comes into rescue. So via derivative the credit risk is transferred, not by selling the asset. You can think of it like insurance on the risk. It is often involves CLN, that is called credit linked notes, or it also involves CDS, that is called credit default swap. It's ideal when bank want to retain ownership of the asset but offered risk. So that is called and one more thing, this is tranching structure. What it means? Securitized products are often divided into multiple layers. So whatever product is securitized, let me explain. Securitized product are divided into multiple layers, right? And each layer is what we call tranches. So you must have heard this word tranches. Tranches means each layer of the securitized product. And senior tranche means low risk get paid first, and mezzanine tranche means higher risk, they get paid later, and junior tranches. So three tranches are there. Senior tranches, which means low risk, they will get paid first. Mezzanine tranches means higher risk, they will get paid later, and finally we have junior tranches. So junior tranches absorb losses first, offering a cushion for other. So this structure help attract investor with different risk appetite. All investors are of different risk appetite. Someone engaged in someone seems senior tranche is interesting. For someone mezzanine is interesting, and for someone junior is interesting. Now if you look at the securitization exposure here on the right side, so this product, the product created can include ABS. What is ABS? Asset-backed security, MBS, mortgage-backed security, or bonds, loans, private equity, or even multiple asset type bundled together. So this kind of instrument it can include with the product which is created by the SPV. And the exposure could be simple or complex, but the core idea is the same: transfer and manage the credit risk efficiently. Now let's look at the credit risk transfer. So what the credit risk transfer is all about, let's look at it. So where it is, as you can see on the right hand side, credit risk transfer, what it is all about. See, basically in securitization, the originating bank shifts its credit risk to the investor, right? So originating bank is the one who is facing the NPA risk and who has started the securitization. So what originating bank is doing, it transferred the credit risk to the investor, right? So this is beneficial for the both. How? The bank reduces risk exposure and the investor earn a return based on the credit performance of the pool, right? And there is something called cleanup call. What is the meaning of cleanup call? This is a smart exit mechanism. This cleanup call is called a smart exit mechanism, right? So what happened in the cleanup call, let's understand that if the pool value drop below a set level, right? Suppose the pool value, because assets are securitized in the pool. So if the pool value drop below a set level, if it drop below a set level, the originator can trigger a cleanup call. This is triggered by the originator, basically repurchasing the remaining security and closing the deal. So whenever I say cleanup call, what they do, they repurchase the remaining security and they close the deal. And there is something called ABCP, that is called asset-backed commercial paper. What is it? It is a short-term version of the securitization, right? Short-term version of securitization, typically 1 year. The SPV issue commercial paper with a maturity of less than a year, backed by the underlying asset. So basically what is happening, this is SPV and they issue CP commercial paper, right, of less than 1 year, and it is backed by the underlying asset, right? So it provides quick liquidity, commonly used for corporate funding. So that is the point. So securitization is like turning financial liability into tradable opportunity. It manages risk, it unlocks liquidity, and it keeps the credit wheel of the economy moving, right? More than a process, it is a strategy. That is called SPV. I have discussed every aspect of it. Now friends, let's shift our focus to the credit enhancement. Very, very important aspect. So in the world of securitization, managing risk is not just important, it is essential. Today, we are diving into critical piece of the puzzle that is called credit enhancement and a structuring tool, right? And basically it's a structuring tool. What it is all about, let's understand. So credit enhancement and a structuring tool ensure stability, transparency, and investor confidence. So why would any investor buy security backed by loan or mortgage? Why any investor will buy any security which is backed by loan or mortgage? Simple, because of the credit enhancement. This is the reason why investor buy this security. So these are the risk mitigating tool. We can call it, risk mitigating tool, right? That make the deal safer and attractive. Let's look at the objective of this credit enhancement. First objective is that, it ensures that originator has a skin in the game and does prior due diligence, right? This is the first thing. Then the second thing is, applicability. It applies to all securitization note except RMBS, that is residential mortgage backed security. Exception is this RMBS. In all the case, credit enhancement is required. There is something called minimum retention requirement. So it is a special rule under credit enhancement. It ensures that originator retain a minimum portion of the exposure. Why? So that they don't offload all the risk and walk away. So what is the applicability? All securitization note except RMBS, they have to maintain a minimum retention requirement. What is that? So see, that depends on the maturity. If the maturity is less than 12 to 4 months, or we can say 2 years. If the maturity is less than 2 years, then the bank have to retain the 5%. If it is more than 2 years, right, and it is and suppose it is more than 2 years, or suppose it is bullet repayment, in that case it is 10%. MRR is 10%, which is more. And for RMBS, which is residential mortgage backed security, retention apply at all maturity. All maturity retention will apply. So this ensures originator are still accountable for the asset performance. And this is a very important concept which you must keep in mind, this percentage. Now there is something called portfolio structuring. What is portfolio structuring? So basically it means, securitization is not a one size fit all process. With portfolio structuring, originator can add the desired asset, right? Because it is no one size fit all solution. It is not a one size fit all solution, right? So with with portfolio structuring, the originator can add the desired asset, they can reduce unwanted exposure, and they can align the pool with the portfolio goal. Then there is something called collateralized loan obligation. In short, we call it CLO. So these are the powerful securitization tool. What is the purpose? The purpose is to offer the risky loan, free up capital, and enable the fresh lending. What is the structure? So asset, usually loan, are moved to the SPV. As you can see, asset are moved to the SPV, special purpose vehicle, and it is issued in tranches: senior tranches, mezzanine tranches. So three kind of tranches are there. I told you that here we have the senior tranches. Senior tranches means high quality tranches, low risk is there. Mezzanine tranches means riskier, lower rating, and finally the subordinate tranches which is highly riskier and rating is also very low. Then we have cash flow prioritization. So cash from the underlying asset is not split equally. Payment are based on tranches seniority. See, senior tranches get paid first, right, with high rating and a strong default protection. Then we have mezzanine subordinate to get paid later, higher risk, low rating. So this waterfall structure helps manage risk effectively. So if we compare CLO, collateralized lending obligation, and collateralized credit linked notes, what is the difference? So CLO, this is basically in CLO what happened, true sale happen. In CLO, asset true sale happen. True sale of asset happen, right? It offers you diverse exposure. CLO offers you diverse exposure, and it may even earn a higher credit rating than CLN. So suppose someone asks you, out of CLO and CLN, who has higher credit rating? The answer is CLO, right? It is ideal for risk transfer and capital relief. But if you look at the CLN, there is no transfer of ownership. You can see truly ownership transfer in CLO, but in the case of CLN, no ownership transfer. Second, rating is capped at the issuer level. Third, less flexibility. That is what. So bottom line is that CLO offer real asset transfer and CLA just pass on the credit risk, right? And more credit rating for the CLO than CLN. Then we have credit derivative integration. See what it is. Today's securitization is not just complete without credit derivative. They enable credit risk transfer between the parties without transferring the underlying asset. Asset is not transferred, yet the risk is transferred. That is the beauty of this credit derivative, right? This unlock a smart structuring possibility like synthetic securitization and customized exposure management. So CBO, bond pool securitization, CDO, which includes CLO plus CBO, right? Tranching is there, risk transfer mechanism is there. So final concept. So let's get started with our first topic that we have. Ever wondered why Basel 3 was ever introduced? What triggered it? And how it is different from Basel 2? Let's decode the powerful transformation of the global banking regulation in simple and visual way. So let me zoom a little bit so that you can easily you can easily view it. So let's rewind to 2008, right? So let's just wait a minute. Yeah, so let's rewind to 2008. What happened? The global financial crisis shook the world, shook the global economy, right? World economy. Basel 2 failed to prevent it. So Basel 3 was introduced in 2010, right? So with a clear mission to plug those regulatory gaps that left the bank vulnerable. What was the objective of the Basel 3? So I hope the trigger point is clear now, that it was nothing but 2008 crisis. What was the objective of Basel 3? To fix the loopholes which was in Basel 2 by strengthening 4 key pillars. Yes, there was 4 major measures like capital adequacy, risk weight variability, leverage control, and liquidity strength. Let's talk about capital adequacy. So one of the biggest shift, capital adequacy jumped from 9% to a much safer 11.5% in the Basel 3, right? It is safe. It moved to the 11.5%. Plus new triggers were added, like if CAR dips below 11.5%, bank must conserve capital, or no dividend, no bonus, no payout back, no bonus payout, and even restriction on buyback, right? All of this to push bank towards safe and responsible lending. So this is the point. And if CAR is less than 9%, then PCA, prompt corrective action invoked, possible narrow banking, right? So these are the limits which have been placed. Now let's look at the reduced RWA variability. This was another smart move. Basel 3 asked bank to reduce their dependence on internal risk model, right? So what Basel 3 asked bank? This is Basel 3, and it asked bank to reduce their dependency on internal risk model. They should not depend more on the internal risk model. Instead, they use a standardized and consistent approach, right, for calculating risk weight asset. Use a standardized approach and a standardized and consistent approach to calculate the risk weight asset for
right? Why? To avoid manipulation and to ensure transparency. Two words are there. First word is manipulation. They want to avoid manipulation, and second one is to ensure the transparency. These two things, that the RWA variability has to be reduced. Then one more thing important is that leverage ratio was introduced. So Basel 3 introduced a leverage ratio, a backup check that ensure that bank don't build up too much risk. Right. Just now I told you that Basel 3 asks bank to reduce their dependency on internal risk model. Instead, use a standardized and consistent approach for calculating RWA. Earlier, bank used their own model, but Basel 3 tells bank to use a standardized model which is adapted across the world. So leverage ratio we have just talked about, that it is a backup check that ensures that bank don't build up too much risk even if they have high capital. Right. Simple formula but powerful impact, that it prevented complex financial engineering from hiding real risk. It's like having a second brake in case the first one fail. That is called the leverage ratio. So the next point is strengthening the liquidity standards. Right. What does it mean when I say? So basically Basel 3 focused heavily on liquidity. Right. The collapse of the Northern Rock showed how bank can run out of the cash. Right. So Basel 3 introduced two key ratios. The first one was the LCR. What is the meaning of LCR? So when I say LCR, it means, just wait a minute, LCR means liquidity coverage ratio for 30-day, HQLA means high quality liquid asset for 30-day stress, and NSFR, which means net stable funding ratio for the long term strength. So that is the first slide we have just discussed. So basically this is the first slide which we have gone through right now. Right. Let me show you a little bit about it. So physically, in short, Basel 3 was not just an update, rather it was a total upgrade to the banking safety built from crisis, designed for the future. Now friends, let me take you through this particular mind map where everything regarding LCR is just shown in one picture. Right, this will help you give you a clear picture, and you can easily solve MCQs and case studies based on them after you have the concept. So liquidity is the lifeline of any bank, but what happened when the stress hit hard and cash dry up? Enter liquidity coverage ratio, or LCR, where this is your banking financial shock absorber. We can call them this is this LCR is just like shock absorber. In one word I can say this is like shock absorber. Right. So let's break down the LCR framework in India, how it works, why it matters, and how it is implemented. First thing first, every bank must maintain LCR of 100% or more. You see this word, they must maintain LCR of 100% or more. Right, all the time. This means they should hold enough high quality liquid asset, enough HQLA the bank must hold, right, to survive 30-day cash crunch. So to survive this 30-day cash crunch, they should have enough HQLA. And if this ratio drop below 100%, what will happen? Bank must submit a restoration plan, right, to the RBI immediately. So remember, LCR limit is 100%. Now what if there is a crisis? So let's talk about the stress. What if there is a crisis? See, yes, bank can use their HQLA and their LCR may fall below 100. Suppose there is a crisis, so bank can use their high quality liquid asset and LCR may fall below 100%, but here is the catch. What is the catch? They must report it promptly to the RBI, which is DBOD and DBS, which is the Department of RBI, right, along with the reason and how they plan to fix it. If you look at the scope of the application, so the LCR framework first applied at the standalone level. Remember, it was first applied at the standalone level, meaning each bank including its foreign branches. Eventually, the goal is to apply LCR at the consolidated group level. Right, this is very important thing. The goal is to apply the LCR at the consolidated group level, and for foreign bank operating in India, LCR apply only to the Indian operation. That is the standalone. Remember this thing. For further goal is to apply LCR at the consolidated level, but for those foreign bank which is operating in India, LCR apply to Indian operation only, not their foreign operation. Understood? Right. Earlier it was just a standalone level, but for Indian bank, that is consolidated level. That means both foreign branches and Indian branches should be taken into consideration. But for foreign bank which is operating in India, it should be a standalone level. These are the points from where questions are asked, and everything I have compiled in just one line based on what we have observed in the past 3 to 4 years question paper. Now if you look at the formula for calculating LCR, it's quite simple. In the numerator you write the high quality liquid asset, that means you write the asset, and you divide it by the net cash outflow, right, for the next 30 days, and the outcome must be always greater than or equal to 100%. So you can write it like this, it should be greater than or equal to 100%, the outcome. Now if you look at the implementation timeline in the left side, you can see that LCR was not rolled out overnight. It started from January 1st 2015. You see, it started from January 1st 2015 and it was gradually phased in. 2015 60%, 2016 70%, 2017 18%, 2018 19%, and 2019 100%, right. And if you look at the pandemic related election, So no rule book is rigid. During the pandemic, temporary relaxation were provided, but one thing is stabilized, full reinstatement kicked in, restoring financial discipline. So LCR is more than a number. It is a safety net, a guardrail that ensured bank remain liquid, credible and resilient even in the most turbulent time. That is all you need to remember about LCR, right? High quality liquid asset in the numerator, and in the numerator what we write, HQLA divided by the net cash outflow in the denominator, right? Now friends, let's look at the next point. That means at least 30-day liquidity banks would have, HQLA divided by the net cash outflow, right? Now friends, let's talk about when a crisis hit, and it should be greater than 100%, means HQLA should be greater than the net cash outflow for the 30 days. This should be the case, right? So how many times HQLA you have as compared to the net cash outflow, that is what it tells you, that LCR tells you. If you go deeper into the high quality liquid asset, let's understand. So basically, when crisis hit, what matters most is not just cash, it is convertibility. Yes, whenever crisis hit, what matters most is convertibility. Let me write it down. What matters most is convertibility, not the cash. Just let me write it, convertibility, right? And that is where HQLA, or high quality liquid asset, comes in. This is the crown jewel of a bank liquidity buffer. Let's decode what make an asset as high quality and why it is central to the bank survival during financial stress. HQLA, let me zoom a little bit so that it becomes very much clear to you. So HQLA, you can call them unencumbered, right? Let me show you. So they are unencumbered, easily sellable, right? And asset with minimum loss in the value, right? So they must quickly convert into cash, especially during a stress. You can think liquidity based on asset type, market depth, stress scenario, and conversion timeline. If you look at the fundamental characteristics of this asset, the first thing is that they have lower credit risk, very low credit risk. They have lower market risk, right? Very low credit risk, very low market risk, right? They should have very low credit risk, very low market risk, and obviously they should have easy valuation. That means reliable valuation. As you can see, they should be valued reliably, and also there should be low correlation with the risky asset, and they should be listed on the major exchange, adding to their credibility. These kind of assets should be listed on the major exchange. Now if you look at the market related characteristics, so from a market view, the asset must be actively traded in the large and deep market, right? And it should have committed market maker and low concentration, ensuring it hold its value even in a liquidity crunch. Low concentration and flight to quality in crisis. If you look at the classification of HQLA, so HQLA are grouped into 3 levels. The level 1, level 2A and level 2B. What is level 1? Level 1 is cash, or we call it near cash asset. Like they are highly liquid, they are convertible on day 1 with no haircut, right? That is called level 1. Level 1, you can take cash or near cash, right? And they are highly liquid, and they are convertible on day 1 with no haircut. What is level 2A? Level 2A means less liquid and 15% haircut is applied. And what is level 2B? They are even less liquid with higher haircut and tougher to convert, right? So they are convertible on day 1 with no haircut. That is the point. Now if you look at the composition rule, so HQLA, this is the rule book for HQLA mixture. So remember, basically what I am telling you, that level 2 asset, which is 2A plus 2B, right? This should be not exceed 40% of the HQLA. Remember, level 2, or which includes 2A and 2B both, right? It should not exceed the 40% of HQLA. And out of that, level 2B is capped at 15% of the total HQLA to avoid over dependence on less liquid instrument, right? So total HQLA, whatever high quality liquid asset, out of that 15%, suppose HQLA is 100 crore, 15% is 15 crore. So level 2B should be less than or equal to the 15 crore. This is the maximum cap. Level 2B cannot exceed that, right? So why? To avoid over dependence on less liquid instrument, right? We should not depend more on the less liquid instrument. That is why this cap has been kept, because obviously it is less liquid. That is why cap is given. And for level 2, it should be less than 40%. It should not exceed the 40%. That is the why level, because level 2 is less liquid as compared to level 1. That is why we should not include more less liquid instrument into our composition. That is why this rule is there. Now if you look at the diversification requirement, this is the golden rule: no concentration risk. Means especially in the level 2 asset, bank must diversify by issuer, asset type and counterparty. So the next time you hear liquidity cushion, think beyond just holding cash. It's about holding the right kind of asset, that is HQLA, that protect bank in the eye of financial storm. So that is as holding HQLA. I hope that makes sense to you. Now friends, let's switch our focus to the NSFR, right? What is NSFR? Every aspect of NSFR is provided in one single PDF. Imagine a bank that looks strong today but collapse tomorrow due to unstable funding. To prevent such a scenario, we have net stable funding ratio, the financial backbone of a long-term stability. Let's unpack the NSFR framework, right, which ensure that banks don't just survive, they thrive with sustainable funding. So this is the basic formula of NSFR. You can see on the left top side, ASF upon RSF, right, where ASF is the available stable funding and RSF is the required stable funding. This ratio must be 100% or more at all time. Like in LCR we see LCR was more, 100% more. Similarly, this ratio should be more. That available stable funding should be greater than the required stable funding. What is the definition of a stable ASF? Let's look at the top right corner. ASF, you can see it here. Let me highlight it. This definition. So ASF, ASF include a stable capital, right, and liability expected to remain for more than 1 year, right? Because source of fund, here we are talking about stable funding. So funding is what, from where we are getting the fund. Obviously fund is generated from what, from liability, but from where bank is getting fund, from capital or borrowing or liabilities. Many kinds of liabilities are there, that is called available stable funding. And RSF is the required stable funding. So RSF depends on the liquidity and the maturity of the asset and off balance sheet exposure. How much RSF always depend on the asset and OBS liquidity and maturity. So what is the goal here? What is the objective? Why we are discussing this NSFR? As you can see on the top right bottom corner, objective. Let's talk about the objective of this NSFR. The goal is to promote long-term funding. This is what we want. We want to promote long-term funding. I told you that we should have sustainable financing. We look at the tomorrow. That suppose our bank condition is good today, what about tomorrow? That is called long-term funding risk, right? To reduce it, to reduce the liquidity risk and to avoid reliance on short-term unpredictable source. That is our objective. So that is objective. Now if you look at the purpose and benefits, so in the top right corner, let me show you what are the purpose and what are the benefits of NSFR. So here you can see that NSFR provide a stable funding, right, for all balance sheet item, whether it is asset, whether it is liability, right, or it is OVS. So it provide a stable funding for all balance sheet item. It reduce excessive short-term fund reliance and it improve the funding risk assessment, right, making the bank fully resilient. If you look at the timeline of implementation timeline, so on the right side you can see, so NSFR, though NSFR was originally proposed for 1st January 2018, but due to COVID-19 it leads to delay. It was finally implemented on 1st October. If we look at the applicability on the left side, so this framework is applied to both the Indian bank, both solo and consolidated level, and foreign bank branch in India on a standalone basis, right? And if you look at the supervisory oversight, so NSFR is monitored using a supervisory review, right, ensuring that bank prioritize funding stability and tackle liquidity risk head on. So basically liquidity ensures survival. So what is the moral of the story that we have just understood? That liquidity ensures survival, but a stable funding ensures strength. While with NSFR in place, banks are no longer walking a tightrope. They are building a bridge to long-term trust and confidence. If this video help you understand the concept, please hit that like button. And if you want to enroll in our crash course, in which you get such kind of PDF for each and every unit, that will help you revise the entire content quickly, and also you will get sufficient MCQs and quizzes for practices along with that. And not only that, right, you will also get previous year questions, some capsule content also. So you need to WhatsApp me on this particular number. Please save that number, or just you can see the description section of this video. There also the course detail has been given. Now friends, let's understand FALLCR. What is FALLCR all about? Just now we have discussed the NSFR. So friends, what happened when a bank run out of its top tier liquid asset during a crisis? Enter the safety net, that is called FALLCR, a strategic liquidity lifeline during extreme stress, right? Tier 1, tier 2, we have just divided high quality liquid asset, level 1, level 2, right? Now in this segment, let's decode FALLCR, or facility to avail liquidity for liquidity coverage ratio. The full form of FALLCR? Facility to avail liquidity for the liquidity coverage ratio, right? Remember, it kicks in only after all other HQLA are exhausted. So that is the eligibility criteria. It provides additional liquidity support, right? It provides additional liquidity support using eligible government security, but it kicks in only when all other HQLA are completely exhausted. It is the emergency backup, not the first line of defense. Remember, it is emergency backup. The first line of defense is the LCR, HQLA part, level 1, level 2, that we have discussed already. If you look at the key feature, it is a stress only tool activated under the crisis, permitted through RBI 2014 circular bank can use FALLCR only after fully utilizing their MSF, marginal standing facility, and SLR eligible asset. This ensures a disciplined and phased utilization of the liquidity buffer. If you look at the haircut here also apply. So you can see haircut as per the MSF guideline is applied. Tenor is up to 90 days, and rate is 200 BPS above LAF repo rate, right? For for up to 90 days or as specified by RBI. So it is supportive but not the cheap. Now if you look at the level 1 HQLA, just look at it. Here is where the things get interesting. What are they included in level 1 HQLA? Let's see. So level 1 HQLA includes SLR plus security under MSF, right? SLR plus security under MSF 2% NDTL plus SLR under FALLCR, which means 9% NDTL. So FALLCR extend the pool of asset eligible for LCR. That means it strengthens the liquidity resilience. So you can see it includes a level 1 HQLA include SLR plus security under MSF and SLR under FALLCR. Now if you look at the valuation requirement, all security used for LCR including those under FALLCR must be valued at the current market price. They should be valued at the current market price, regardless if they are under HTM, AFS or HFT. We have already covered this HTM, AFS and HFT in our live session. We have discussed numericals based on them. So what we have discussed just now is that FALLCR is not just a backdoor option. It is a strategic liquidity reserve built to reinforce confidence during the financial storm. It's it's like last mile fuel that ensures that a bank keep running even when everything else is dries up. Now friends, let's look at this particular table, very important table, and questions are asked based on this table. That's why I have put it here. This is about Basel III liquidity return. Ever wondered how bank prove that they are liquid enough to survive a crisis? Not just once but every month. Welcome to the world of Basel III liquidity return and available stable funding factor, the behind the scene check that keep our banking system rock solid. Let's begin with a mandatory requirement that bank must submit under the Basel III norms, collective known as BLR, that is called Basel III liquidity return. The full form is called BLR. Let me show you. This is called BLR. So the first thing is LCR return. You can see LCR, that return, that is BLR1. This is the liquidity coverage ratio that is filed monthly within 15 days, right? Then we have BLR2, which is funding concentration. Remembered it, right? It is also to be filed monthly within 15 days. Then we have the unencumbered asset, that is the BLR3, right? It is quarterly. It is reported quarterly, and basically it tells RBI that which asset can be really solid, right? And it is done quarterly. Then we have BLR4, which is LCR by significant currency. It shows if liquidity is maintained in every major currency or not, right? If liquidity is maintained in every major currency or not. And then we have other liquidity information in BLR5. Any extra liquidity data that RBI want, also monthly it is done. So the key takeaway is that the RBI keep a tight watch with report due. We see maximum case there is 15-day report. Only 2 cases 1 month report, that is BLR3 and BLR4, right? Depending on the type. Now friends, let's look at the next section. This table you must keep by heart it, right? When it is monthly, you can see the maximum case it is monthly frequency of submission, but only BLR3 it is quarterly, right? And here it is month. So this way you can remember it. Now friends, let's look at this particular table, super important. So let's dive into how this available stable fund, that is called ASF, how this ASF is measured, critical for the NSFR. Obviously, how to measure this ASF. So the table categorize liability based on their stability and assigning a weight, that is ASF factor to each. Because because stable funding is always about the liability, right? So which kind of liability should be assigned 100% and how much ASF should every liability be assigned. So the first case we have is the 100% ASF. As you can see, what are included here, you must know it. Just wait a minute, let me show you. So under 100% ASF, what are included? So total regulatory capital, first thing, long-term borrowing, right, over 1 year. You can see maturity of 1 year or more. These are 100% ASF. Then we have 95% ASF, which means retail term deposit with maturity over 1 year. You can see retail term deposit with maturity of over 1 year, that is 95%. What about 90%? So is it a small business term deposit over 1 year, right? A small business term deposit over 1 year. You can see that is 90%. Then we have 50% ASF, like funding from corporate or financial institution, right? If we talk about 50%, then funding from corporate, other financial institution, even a stable deposit can carry moderate risk here. Then we have 0% ASF. So unsecured, you can see which cases having 0% ASF, like unsecured wholesale funding, right? Unsecured wholesale funding under 6 months, short-term borrowing from financial institution, derivative, trade-related payable, and non-stable source. So what does this mean? That the longer and more detail oriented your funding is, the more reliable it is in liquidity crunch. So remember it, right? So in the last case we have seen that unsecured wholesale funding under 6 months, they have zero available stable funding, right? So basically the rule is that the longer and more retail oriented your funding is, the more reliable it is liquidity crunch. That is point. So these reporting norms and ASF weight ensure that bank don't just chase deposit, but focus on long term, stable and diversified funding. Because when a storm hit the financial system, it is not about who has the most, it's about who built to last. Then look at this particular table. When a bank lend money or invest, how risky is that from a liquidity perspective? So Basel III answer this by assigning RSF factor to every asset. Here you will see RSF factor. So whenever bank lend money or invest, how risky is that from liquidity perspective? This is done by RSF. Let's explore what made an asset more or less stable. Asset. Last page we talk about liability stability. Here we are talking about asset stability. So first case we have is 0% RSF. You see which case is having 0% RSF? Like extremely liquid, right? So no stable funding is needed for that, right? Like coin and banknote, cash reserve ratio, right? All RBI balance and claim within maturity 6 months. They are extremely liquid, highly liquid. So there is no requirement of a stable funding, right? So for these assets, no stable funding is required. Then we have 5% RSF. Low risk, minimal stable funding needed. Like level 1 asset, like government security, CRR and unencumbered SLR security. Then we have 10% RSF. Right, like some SLR encumbered, this is security encumbered, loan to bank maturing in 6 months, right? Then we have 15% cases, so loan to financial institution with maturity under 6 months, right? Then 15%, then 50% you can see. So 50% unencumbered level 2B asset, right? So and other loan maturing in 6 months to 1 year, right? They are under 50%. Then we have 85% case, right? This question was asked last time. 65%. Right, so 65% cases you can see unencumbered standard residential mortgage with a residential maturity of 1 year and with the minimum risk weight permitted under the standardized approach. Remember, this is 65% RSF, right? Then we have 85% RSF for a standard loan to customer maturing in more than 1 year, right? Other unencumbered performing loan with risk weight greater than 50%. So you must know this. And 100% RSF is for all other assets not mentioned above, and including high risk retail or SME loan or loan to NBFC, and 100% RSF. So friends, the RSF framework pushes bank to fund long term and illiquid asset with equally stable resources. The deeper the risk or the longer the wait to recover fund, the higher the RSF factor. And that is how Basel ensured that bank don't run dry when market go dry, right? So that is all we have discussed. 66% we have seen. So home loan with decent credit profile and sound documentation, they have 65% RSF. Just now I told you, right? Then we have 85% RSF for derivative transaction, right? Margin requirement, cleared exposure to CCP, right? Also loan with higher risk weight under standardized data. So just go through it, right? We have discussed it. So RSF scale like a risk mirror. The longer, riskier or less liquid the asset, the heavier the stable funding needed. This ensures bank remains solid even when a storm hit the financial stage. So the longer, the riskier or less liquid the asset, the higher the RSF. So that is all you need to know about this particular topic. Nothing extra. Just go through it. Just solve the numerical and keep